Blackrock and Larry Fink have changed the game for Bitcoin. But underneath of the headlines, there's a much more sinister reality that people aren't awake to.
Basically, when you look at the share ownership sheets of all of the corporations in America and you see BlackRock, Vanguard, State Street at the top, almost all of that percentage of ownership, which is like 30% of the total market value almost, all of that is representing our money and what would be our voting power. But because they are managing the voting power, they have usurped our right to lead the direction of our capitalistic system. And that is deeply insidious.
I talked to the CEO of a new asset manager who's aiming to disrupt BlackRock and the other big players in the space.
It's concerning to say the same three entities basically control every single publicly traded company. They control Pepsi and they control Coke. They control Nike and they control Adidas. So you have these companies that are competing with each other, but yet upstream, they have the same owner.
Strive, the firm founded by Vivek Ramaswamy, has grown to over $2 billion in assets under management by being unapologetically pro-shareholder and pro-Bitcoin. Matt Cole and I sit down for a discussion on the dark realities behind the Bitcoin ETFs and his perspective on Bitcoin's future as a guy who's managed a $70 billion portfolio. You won't want to miss it. This is Dante Cook with Bitcoin Simply. Let's go. What's up, everybody? Today's episode is going to be a little bit different from the 10 to 15 minute, high energy, high information, dense Bitcoin packed shows that we normally do. And we're going to switch it up and do a little interview. I got to sit down with Matt Cole, the CEO of Strive Asset Management, who's legit. He managed a $70 billion portfolio for the largest public pension fund in the world, in CalPERS. He knows what he's talking about, and his insights on how Bitcoin is transforming Wall Street have some weight to it. Stick around to the end to hear his thesis about Bitcoin at Strive and what they're building. Without further ado, let's get started with his background.
So I was, I don't say this to brag, but my team was the top performing team at CalPERS. We had outperformed our index for 11 years straight, basically every year after the great financial crisis till the time I left the firm in 2022. And, that's so 11 years outperforming our index, managing $70 billion. And we made $1 billion of alpha aggregate over those 11 years. So call it, just under $100 million of alpha a year for, a small team.
It's funny. For all the success that he says that he had over that 11-year run, he admits that they missed the mark completely. And this is the problem with bonds. He lays out the problems, the long-term structural problems for bonds moving forward.
That's a lot of money. But you then look up and you realize that the fund is $200 billion underfunded. And if you're the top performer and you've filled 1/200th of that bucket, and then it's a broken system, right? And so I really cared about, I still really care about CalPERS, actually. I mean, most of my family has their pensions tied to CalPERS. It's literally a personal mission for me that CalPERS remains funded, similar to Dom Bay running for CalPERS board right now, right? It's a personal mission for a lot of people to help this problem, but you actually have to think very macro about the problem, not micro managing, whatever a $70 billion portfolio, which is a lot. You have to think of a bigger way to fix this problem. And so, I was there on the trade desk and was a longtime Bitcoiner. And I really did look at the problem to say, okay, from 1980 to 2020, you had a 40-year rally in bonds where bonds had negative correlation to equity. And they also had really good total returns, right? Not just the yield, but the total returns, because yields were in the teens for treasuries and they dropped basically to zero in 2020. So that's increasing the price, right? So you have price increasing and a decent yield. Now we have the opposite, right? Where yields hit zero and they're either going to flatline at a still pretty low level from an investor perspective, or yields go higher, which means bond prices go down. Either one of those scenarios kind of breaks this 60-40, which is not the pension model, but 60-40 model of stocks to bonds that a lot of people talk about, right? With this negative correlation benefits. That model is now broken. I'm firmly in the belief of a global fiat debt crisis. And that was even before I was a Bitcoiner. You're just seeing the rise of debt in the United States, around the globe, and to these unsustainable levels. And if that breaks down, while pensions are underfunded, you got to think differently. You can't think just with the consultant class, what's been true to the last 40 years. And that to me is where Bitcoin specifically can act as a hedge, where if you think about the liabilities of a pension, they're very long run liabilities, right? We're talking about liabilities over the course of decades, not the course of years. Bitcoin is actually an asset that has a very, very long duration as well, where it's not paying off like debt. It's just a commodity that has very, very, very minimal inflation. It's the most scarce asset in the globe. The first time actually that we've had a truly scarce asset, and you're seeing, I think, the emergence right now of a global race to acquire Bitcoin.
And this is what caused Matt to leave his role at CalPERS. He wanted to go to a new mission for a new chapter in his career, one that was centered around his belief and his philosophy around the ethos of Bitcoin. He loved the fact that Strive had a shareholder-first ethos. Here's one of his takes on one of the biggest issues with ETF issuers today that no one talks about.
So first off, some people may know this, some people may not know this, but the largest owner of almost every publicly traded company is the combination of BlackRock, State Street, and Vanguard. And that ownership position of those three investors often gets up to the 15 to 25% ownership level. And so they own a large slug of those companies. And then what's also, you might not know, is that, obviously everyday Americans also own individual stocks, but most everyday Americans don't vote their shares. And so if you think about any election, just think about an election. If someone doesn't vote, then there's more power to those that do vote, right? And so that ownership position for the State Streets, the BlackRocks, the Vanguards gets amplified because they're voting all their shares and many other people don't vote. And so they basically become close to the controlling shareholders of every publicly traded company.
And here's what's even worse. What happens in the future when BlackRock owns a majority of people's Bitcoin? And when it comes to make a vote on Bitcoin or on block space or some other major issue like the block size wars in 2017, well, what happens if BlackRock votes in their interest and not in the interest of their shareholders?
There are instances where this can matter a lot. If you think back to 2017, where there was the hard fork debate, right, where there was two different Bitcoins. Well, what would the ETF do in that instance? What side of the debate would they take? In that instance, that could have been very impactful if instead of having a distributed ownership of Bitcoin, you had concentrated ownerships of a handful of ETF providers that may all have the same view. I think that there's instances where this could matter a lot. I think that custody risk, generally speaking, is underpriced and underappreciated. And it's kind of one of those scenarios where it may never happen, but if it did happen, it could be very bad. And that's not an attack actually against even BlackRock. It's a risk. It's a risk that ETF shareholders should be aware of. And a lot of people own ETFs. There's a Bitcoin ETFs. There's a lot of advantages to being able to own them very simply in an IRA or whatever account you might have in your 401k account. But there are risks as well with basically most ETFs custodying at one centralized location.
Matt goes into his thesis on how Bitcoin is disrupting the S&P 500 and how there's going to be massive turnover in the S&P 500 due to AI in the future. But first, let's go to our sponsors. Since 2018, Ledn has been the leader in Bitcoin-backed loans, allowing you to unlock liquidity in your Bitcoin without selling your Bitcoin. The process is simple, fast, easy, and transparent, and they've never lost a single sat or cent of customer money, which is why they have over 1,000 five-star reviews. Your account could be funded in less than 24 hours. Actually, it's 18 hours on average. Loans start out at just 12.4%. And for people that watch this show, you'll get 0.25% off of your first loan. Go to learn.ledn.io/simply to get started on your Bitcoin-backed lending journey today. That's learn.ledn.io/simply. One of the ways that you can remove yourself from the potential saga of BlackRock voting in their interest and not yours by holding a Bitcoin ETF is by holding a real Bitcoin and then having that Bitcoin in self-custody. Well, I know for some of you that may be a leap. And so that's why we partnered with the Bitcoin Way. They will help you remove your Bitcoin from third-party exchanges like Coinbase safely, confidently, privately, and securely. They help you to protect your generational wealth the right way. Schedule a free 30-minute consultation with their team at thebitcoinway.com/simplybitcoin. So, on to the fun stuff, like the S&P 500 being 50% different over the next decade due to the disruption in AI.
First, Bitcoin is by far the most scarce asset, and we're moving towards a world of abundance. And so I'm personally been a long time Bitcoiner since 2016, 2017 on a personal basis. And I think that it's matured to the point where it has a place at every single level, from the individual to the corporation to the state to the nation state. And so you have a scarce asset in a world of abundance. You have massive disruption coming with AI. And so if you look at just technological disruption as a general statement, in the dot-com boom, over the course of a couple of decades, there was over 50% turnover in the S&P 500. And I think AI will be an order of magnitude larger of disruption than even the internet was, is what our view is, and likely at a faster pace than the internet disrupted. And so how fast? I don't know, but I can just tell you like a framework. Let's just say we cut it in half, a couple decades to 10 years max. In 10 years, you could have a 50% disruption in the S&P 500. We're moving towards a world of abundance. We're moving away from globalization. Not that we're going to completely deglobalize, but we're moving in a direction of deglobalization with the global fiat debt crisis. All of these things point to Bitcoin being a winner and a hedge in a major way. And so I think that there's a lot of unknown, and you could go down the rabbit hole of complicating things in a major way. And every single one of these people, from states to corporations to individuals to nation states, should lean into AI, should adopt AI. Everyone should be learning AI. But if you're a corporation, that may not be enough. And so this kind of gets into even like when we engaged with Intuit. You look at their software stack, and it's not hard to envision a scenario in the future where take a product like a TurboTax that most people may not need TurboTax in the future, because you could just have AI do your taxes and do it for you, and do it to the same degree for free, just using ChatGPT. And so, yes, some people will still use the product. Yes, they still have a brand, but it's likely not going to be enough for them to just lean into AI and leveraging that to technologically advance their company. And I think so many different sectors have similar problems. And so if you're having that problem, well, the only way that you can truly ensure your future is to have a lot of capital on the back end. And Bitcoin is capital. It's permanent capital. It's not a checking account. It's a savings account that's proven to go up over time. And our view is will continue to go up over time. And so it allows these companies to live to see a better day, to reinvent themselves, and not just to buy Bitcoin and never do anything else again, but to kind of take some pressure off and be able to see and reinvent and pivot into the future. And I think that it's a tough sell for many, and I think that many that don't will ultimately be replaced. But our view is, our clients own all these companies. I would rather not have 50% of the companies our clients own drop in value and fall out of the index. That's not a great scenario for our investors. I'd rather have them stay in and prepare for this future.
What do you think will be easier to project in the future? How many companies in the S&P 500 are actually going to be there for tomorrow because of the disruption of AI? Or that Bitcoin will still be a global scarce asset with growing demand and shrinking supply? Here's one final thought that I want to leave us. I saw this in a conversation between James Seifert and Natalie Brunell, that it's not the hedge funds which are going to be the next big catalyst in Bitcoin and driving Bitcoin adoption. It's investment advisors.
I think we're over 1,500 or something. Corporations and institutions are adopting this. If that wave continues, That's a huge amount of demand for Bitcoin, isn't it?
Yeah, so that would be the next big catalyst in my mind. So I mentioned hedge funds are the biggest holders. The next one is investment advisors. Investment advisors are big buyers of these ETFs.
One of my favorite clips from my conversation with Matt Cole was how he's an orange-pilled advisor saying that he doesn't sleep well if he's under-allocated to Bitcoin. And his new wealth management firm, well, they allocate at least 3 to 5% of a client's portfolio into Bitcoin and wish that he could allocate more. This is the future that people aren't recognizing. This is underpriced.
We have an asset management segment to the business. We have a wealth management segment to the business. The wealth management segment actually just launched in November of this year, where one of the differentiators there is that we actually recommend a core allocation to Bitcoin to all of our clients in the 3 to 5% range. And what's interesting about that is that's actually constrained if you actually think about portfolio optimization of how do you maximize risk-adjusted returns. You just put it in the Markowitz model. It actually will recommend a higher allocation to Bitcoin, but our view is that education is a really key component of Bitcoin ownership. So like for myself, I own substantially more of my net worth in Bitcoin than that, north of 50%. But part of that is that I've educated myself. I'm very comfortable around owning Bitcoin. Frankly, I don't sleep well unless I have a large exposure to Bitcoin because of my view of the world. But anyways, that's the wealth side.
With orange-pilled financial advisors and firms like Strive Asset Management on Bitcoin's team, the future is pretty bright. If you want to continue your journey on a bright orange future, well, I suggest that you get your tickets to the biggest Bitcoin conference of the year. The Bitcoin conference happening in Las Vegas from May 27th to May 29th. The Simply team's got you hooked up. Use the code SIMPLY at checkout in order to get 10% off your ticket. Come join the crew and 20 to 30,000 other people who believe in a bright orange future. Thanks for checking out a different kind of episode that we normally do today, but one I think is hugely impactful. This is Dante Cook with Bitcoin Simply. Happy stacking. Go Eagles.